Hi everybody. Sorry I'm not able to join in person, but I'm hoping that this video of my presentation will suffice. So just going on from what Armel was just presenting on public equity, we're going to switch gears a bit here and turn to private equity. Just to set the stage a little bit, a report by Preqin, which is an asset database, reported that the real asset private equity funds exceeded $670 billion from 2003 to 2012. So that really just shows you the scale of the assets available in private equity to invest in agribusiness or farmland or other ventures that we're looking at in this space. So what is private equity? I'm sure all of you have somewhat of an idea, but I just wanted to set some ground rules. So basically, private equity funds are made up by high net worth individuals. They tend to invest in assets that are not publicly traded on the public stock exchange. They invest in mature companies who have a proven track record and are successful over many years. So not any startups. And they also expect a 2 or 3 times investment return on their investment. So they're expecting a big return. They're looking for the long game. These investments usually last 5 to 7 years. So this is a bit of a different perspective than what we were previously looking at. So how does private equity meet agribusiness? Basically, in the 1990s is when investors started moving away from the traditional 60-40 mix, which was 60% stocks and 40% bonds investment portfolio. That was historically what they did, what provided a regular return. But so they started looking to diversify their portfolios, and that's when agribusiness and agriculture started to come into frame, and private equity investments were really ballooning. Since 2007, private capital in farmland and ag has grown considerably. After the market crash and realizing that some of the other investments were risky, such as real estate and other things, uh, there were some pretty big macro trends that encouraged this investment in private equity in farmland and agribusiness. For example, just population growth generally. Obviously, with a bigger demand on our land and our food systems, there was an opportunity for business in the future. The financials and the of the commodity prices, the high internal rates of return, and the increasing value of farmland globally was really attractive to these investors. And then also the higher productivity opportunity with the different agricultural technology advances, realizing that with the right investments, you could really start producing more on these lands and getting a higher return from these lands. So they really saw that as a big opportunity and started investing. So private equity started investing in farmland. So this chart here just shows the food and agriculture investment funds from 2005 to 2013. As you can see, pretty much all of these different asset classes have investing more in agriculture and food. The blue here is actually private equity, so that has increased over 50% over this 10-year time span. The green is also farmland, which is also interesting. So you can see there's been a big increase in those investments as well in recent years. With this slide, I just wanted to show you guys some of the private equity firms that are investing in agribusiness and in farmland. And so as I was looking at these different firms and their portfolios and how their investments are set up and diversified, the big takeaway I got was the opportunity to kind of be that player between private equity and venture capital. So if we were able to align with our investment portfolio or as investment managers or whatever our business scope is, these big private equity firms who are basically land grabbing and scooping up all of these huge land masses and productive lands with these small new tech agribusiness venture capitalist, we could really introduce the two and maximize the efficiency on some of these large croplands and really get a huge return. Obviously have to be done very skillfully and correctly, but from my research, nobody's really intersecting these two investors just yet. And this graph is similar to the previous one. The blue here is private equity and the green is farmland. So this is showing you the different asset classes by region. The big takeaway here is that the opportunity for private equity growth is in North America, also in Oceania, and then the big opportunity for farmland is in Europe and Africa, where it's been low historically. So what the big takeaways from the research generally was that the U.S. remains to be an important opportunity for agriculture investments. So about a third of farmers in the U.S. are currently approaching retirement, and as much as 50% of farmland in the U.S. is expected to change hands over the next 10 years. So who's buying that land, who's taking over those productive farmlands and then getting those returns is yet to be seen, but it could be private equity. So there are also other places in the world, Canada and Australia, who have similar regulation, sound government, productive land, and established farmers and infrastructure are also good private equity investment opportunities. If we're going to look outside the U.S., Brazil and Argentina have been places where some private equity firms are starting to look. Less so in Africa. There's actually more risk in Africa. So if we are going to look as far as private equity out of the U.S., there's some important criteria we should consider. The political stability of the country. So are we going to invest our money and are we going to be able to maintain that land and maintain control of it in whatever political environment is there? Is there already infrastructure? Are there roads that we can export the goods that we're producing? Are there already some bigger capital investments to show that this land is highly productive and worth this big investment? The land cost and quality, land ownership and the security of foreigners there, that's again with the political stability. The capital flow mechanism, so are there banks there? Are there ways to move large sums of cash and to get it out on an annual or even longer basis? And can we really trust these markets? And generally the labor market, is there an established labor market? Are there people willing, able, highly skilled that can work these lands and help us make the best use of them? So these are just some things to consider if we're going to look at investing in a private equity fund, either here in the US or in a foreign country. So the other part of private equity investment is in farmland, which I alluded to briefly earlier. So historically, farmland has had good investment returns, and this is basically because obviously food is an inelastic good. If you had a private equity investment thesis on farmland, it would read that securing and consolidating already productive land with low cost to profit from the land transformation or appreciation. So that's kind of the basis of why private equity would invest in farmland. So if private equity was going to invest in farmland, there's two different management styles which would dictate kind of where and how large this investment would be. So direct operations investment would tend to happen in the developing world because you may not trust leasing the land there. You may really want to have your hands on it. You're basically giving a lot of money to a foreign land. So investors then would want to have direct input on that land. This obviously has a higher risk return profile, but at the same time it has while it has a higher risk, it also has higher return. So that's the give and take and really is at the discretion of the investor and what their interests are. The payments are received over time once the yield is sold. So that's a kind of a different payment mechanism for direct operations. And this requires a really high level of skill by whoever is managing it directly. So those are just some things to consider if we're going to pursue that management style. For leasing the land, this is often done in the US and in the developed world. So if we were to invest private equity into farmland in the US, we would probably want somebody who has been working that land for 10 years, knows how to grow the crops, knows the seasonality. So we would really just lease that land to that person to manage it because we trust them. There's a long history there. So the risk in this kind of investment management is relatively low. The return would be about 3 to 5%. You would receive the payments from this investment on an annual upfront basis. And kind of the major drawback with leasing the land is that with this, thinking back to sustainability and environmental considerations, if you're leasing the land to somebody who's been managing and operating it for 20 something years, or the next generation or their son, they're going to continue to manage it how they've been managing it. So there's less transparency and less opportunity to really implement kind of these innovative, sustainable practices that would make this environmentally friendly and an investment worth taking. So what does the market look like? So farmland investment has become popular over the last 10 years. There are really favorable supply and demand fundamentals that are influencing this trend. Globally, the investments are safe assets, and investors are interested in diversifying their portfolios. And quite frankly, farmland is it's a really sound investment. People need to eat, and if you can have a stable climate and a proven track record of high productivity of a piece of land, it's a pretty safe investment. And then also thinking with your private equity cap on, if you also have investment capital to improve the efficiency of that land with, state-of-the-art tractor or GPS tracking or these other technologies, it's a no-brainer from that perspective. So this chart here just shows the risk-return portfolios of timber and farmland asset classes. And kind of the main point here is that U.S. farmland has a relatively low risk, but a very high return. So that could be somewhere we're looking. Although it really is important to note, there are some investment risks, even though this seems, again, like a no-brainer. As we're seeing this, other investment firms have also seen this trend, so they've kind of rushed in, and we have actually seen a real estate bubbling of farmland in the U.S. For example, some land in Virginia, you have private equity and other investors who are kind of land grabbing and going at it so quickly. In some cases, they're now paying more than the land is actually valued at. So we should be very safe, take that into consideration if we're going to invest in the U.S. There's also a yield and price risk. Although we're in this for the long run, again, 5 to 7 years, on an annual basis, the yields may go up and down, and the prices of those different commodities may go up and down. So there is a risk there. And then just the direct management risk. Do we want to take on this management? Is this something worth investing in for us? So kind of bringing this all back to sustainability, the opportunities for sustainable management as well as capital and technology to capital deficit or even financially distressed farms could mitigate effects of prior unsustainable practices. So this is what I was alluding to earlier. If we are going to go into these farmlands, we could potentially implement more sustainable farming practices. Some of the things we've learned, like natural infrastructure, digging ditches to collect runoff, to protect from downstream eutrophication and other things. If we are buying up these farmlands and investing in them, that we will then have control to make them more sustainable. But the other side of this coin is if we're looking outside the US, we should really consider the potential of pulling money out of those local economies. it's really not going to be worth it if we're investing in a foreign country and we're making the land more sustainable, but we're taking all of the returns from that land away from the local economy. That's really does not align with the other two pillars of sustainable development, if we're not going to really give back to that local economy.